This is a video that will complete the portion of our Chapter 24 work on standard cost, which we weren't able to complete in class. And this is a comprehensive problem, and it's going over a corporation named Tyrek. And we can see up top here that Tyrek has established the following standard cost for the production of one completed unit. That includes expected cost of materials at $32, expected cost of labor at $30, and overhead at $45, meaning that Tyrek's standard cost for a completed unit is $107. Now, during the accounting during the accounting period, Tyrek purchased 500 pounds of raw materials for cash at $10 a pound. So let's take a look at that computation. 500 pounds of raw materials, the cost per unit to purchase it was $10, so the actual material cost that we'd spent was $5,000. Okay, now we compare that to the materials that were purchased, and we compare that at standard cost. In this case, it's 500 pounds of materials that was actually purchased times the standard cost per unit of $8 per pound equals $4,000 in standard material cost. The difference between the actual cost and the standard cost results in a material price variance that is unfavorable. Now, if we're going to make that turn that into a journal entry, we're going to do it through crediting of cash for $5,000, debiting the cost of raw materials for $4,000, which is the standard cost of the raw materials, and debit our purchase price variance. We debit it because it's an unfavorable variance. We debit it for $1,000. I'm not going to do the posting to the T account. I'll let you do that yourself, but the basics are here. Okay, now entry B, basically Tyrek Corporation produced 100 units. So we produced 100 completed units, and Tyrek used 380 pounds of material. So what we want to do is calculate our actual material usage, but at standard cost. So what we're going to do is we're going to take the actual materials that were used, 380 pounds, times our standard cost per pound of $8 per pound, and the actual material usage at standard cost equals $3,040. Now we want to compare that to the number of the amount of materials that we had planned to require to produce the 100 units. So to do the computation, then we start out with the number of units produced, which were 100. We know that according to our bill of materials at the top, we should have used 4 pounds of material for each unit we built. So we take the 100 units produced times 4 pounds per material for the units that that were completed. They should have taken 4 pounds apiece. Our total material usage now is 400 pounds at standard. We multiply that 400 pounds times the standard material cost, and it comes out to $3,200. So we compare the materials actually used at standard on the left versus the materials that we expected to use, in other words, standard materials at standard cost on the right. And we have a difference. In this case, a material usage variance is $160 favorable. We used less materials than the plans called for, and the $160 is the effect of that. Okay, the next item after that then is to construct the journal entry, and that's going to be credit raw materials for $3,040, debit our work in process at standard at $3,200, and then credit raw material usage variance for $160. Okay, now C, we're going to calculate our labor inputs. It took 270 hours of labor at a labor rate of $12 per hour to make the 100 units. So that's what that's the amount of labor that we input plus the actual labor rate. So we take a look at labor at actual, and the actual labor rate is $12 an hour times our times actual labor hours, means our actual labor cost, in effect our payroll, is going to be $3,240. Now, in order to get the labor rate variance, we're going to compare that labor at actual against the actual direct labor hours at our standard labor rate. So our standard labor rate is $10 an hour. The actual direct labor hours that we used was 270. So the actual labor at standard cost is $2,700. So now we compare the labor that we actually incurred to $3,240. We compare that to the actual labor that we predicted that we would have incurred at the standard labor rate of $2,700, and the difference between the two is $540. Since our labor at actual is higher than we anticipated at the standard rate, we have a $540 unfavorable variance. Now we're going to calculate our labor if everything was measured at standard. Okay, the number of units that we produced again were 100 units. The standard labor hours per unit called for 4 hours per unit. So the standard labor hours incurred for the accounting period were 400 standard labor hours times our standard labor cost tells me our total labor, if measured at standard, would have been $4,000. So we compare our standard labor rate at actual direct labor hours to our standard labor at our standard, and it's going to come out to a variance of $1,300 as a favorable variance. And the total labor variance then is going to net to $760 favorable. Now I'm going to carry this information on over to the next slide so it'll be easier to view. If you take a look at the top, these are the amounts basically that we had calculated. Labor at actual $3,240, standard labor rate at actual direct labor hours $2,700, and labor at standard $4,000, plus our two variances culminating in a total labor variance of $760 favorable. Now what we need to do is insert the journal entry to record these accounting transactions. And we start off with our cash payroll, $3,240. That's our actual payroll, $3,240. We then debit our work in process at standard. In this case, our standard is $4,000, so work in process is $4,000. We notice that we had a labor rate variance of $540 and it was unfavorable. That means we're going to debit the labor rate variance for $540. We also know that we had a labor efficiency variance of $1,300 favorable, and a favorable variance is a credit, so we credit our labor efficiency variance for $1,300. Okay, let's go on to the next slide, and it's the D. Factory overhead was applied using the predetermined overhead rate at standard hours for each unit produced. Now what we're told is the actual factory overhead incurred during the accounting period was $4,750 to produce those 100 units. So we insert the actual overhead that we've incurred, and notice it does say factory overhead was paid in cash, so our cash is our balancing account. Now we want to compare that to the overhead that we actually applied, or that we applied to production at the standard overhead hour rate. So our predetermined overhead rate in this case is $15 an hour per direct labor hour. We're going to multiply that times 100 units produced times the standard hours that we expected to take per unit. So it's 100 units times 3 standard hours, and if we multiply that quantity times a $15 predetermined overhead rate, we come up with $4,500 worth of overhead that was applied to production. So if we look at the difference between the two, what we see is we have a total overhead variance and it's unfavorable for $250. Now we're going to go over the journal entries for D and E as calculated here. If we take a look at D, we credit overhead for $4,500, which is the amount of overhead that we've applied to production, and there's the amount that we've applied to work in process and production of $4,500. Then E, we record the actual overhead that was incurred. In this case, we're going to credit cash for $4,750, which represents the amount of cash that we spent on the overhead, and we debit over the overhead account for $4,750. And if you notice here, I did post to these T accounts to show you the net effect of these two entries. I've just posted entry D, and I'm going to now post entry E. And you can see when we post entry E, we now have a factory overhead balance with a debit balance of $250, and that represents our unfavorable factory overhead variance. Now if we take a look at F, entry F, Tyrac transferred the 100 completed units to finished goods. So now we calculate the value of our finished goods, or the 100 units that are going to be transferred out of finished goods. So our calculation is 100 units times $107 standard cost per unit. That's going to equal $10,700, and you'll notice since we're transferring everything out of work in process, that's the amount that we're going to credit out of work in process, and when we do that, that account will become zero. Credit to work in process of $10,700, and we debit finished goods for $10,700, and you can see work in process is now zero. Okay, the next item is G, where Tyrex sold 50 units out of our finished goods. So in this case, our calculation is 50 units sold times our standard cost of $107 means that we're going to remove $5,350 of standard cost out of finished goods and transfer that to cost of goods sold. So the value is $5,350, and we're going to transfer that out of finished goods to cost of goods sold. And what you see here is a journal entry, $5,350 to finished goods credit, transferring out, and then debiting to cost of goods sold, $5,350. You can see here the credit to finished goods, and the amount being transferred to cost of goods sold. I do have a remaining balance in finished goods of $5,350, which represents the remaining 50 units at the standard cost of $107 a unit. Now, at the end of the accounting period, Tyrec closed out the variance accounts. So in this case, we take a look at every of our variance account: purchase price variance, material usage, labor rate, labor efficiency, and factory overhead, and we're going to close each of these accounts out. In other words, we're going to zero them out to cost of goods sold. So purchase price variance is first. We go ahead, in order to close that out, we have to add a credit of $1,000 to purchase price variance. That's going to then, the offsetting debit is going to go to cost of goods sold, $1,000. Okay, we're going now to go to material usage variance, and we're going to debit the material usage variance for $160, and then the offsetting credit will be to cost of goods sold. Now we go to labor rate variance. It has a debit balance, so we're going to have to add a credit to that to zero out the balance. So the credit would be $540 to labor rate variance, and then the offsetting debit will be $540 to cost of goods sold. Labor efficiency variance has a credit balance, so we're going to have to add a debit of $300 to zero that account out. There is our debit of $300, and the offsetting credit goes to cost of goods sold for $300. The last account is factory overhead, and we know we have a net debit balance of $250 in the account. So to zero that account out, we're going to have to add a $250 credit to the factory overhead account, and then we're going to offset that with the debit to cost of goods sold for $250. So in this case, then everything is now zeroed out and transferred. The balance is transferred to cost of goods sold. And what I'm showing you here is the summary journal entry. If we were to make this as one single entry, you can see where we're debiting material usage variance, labor efficiency variance, all the other variances, and the net difference in this case is a debit to cost of goods sold for $1,330. Thank you for viewing this video.